It's worth noting, right? Through all of this, I mean, the KRE, which is the regional banking index, is about 26% lower on the year. The XLF is down about 7%. Bank America is down 14.5%. For some reason, Bank America acts much worse than Citi, which is up 2% on the year. Wells Fargo is down 9.5%, and JP is only down 4%. There are implied dividend cuts that you can see in the options market in a name like Bank America. Okay, so think about that. We talked about that last week. So if every federal banking regulator, the White House is calling for greater financial regulation. And Danny, I'd love to get your take on this, okay, because this is really out of the Big Short playbook, if you will, and talking about Meredith Whitney's call was in late '07. That Citigroup was going to have to cut their dividend, right? And that was the thing that caused investors, because there's a lot of investors in stocks like Citigroup, you know what I mean? They're in it primarily for the cash return, right? The dividend payout. So if Bank America right now, looking out, let's call it a year or so, is implying dividend cuts, what does that mean about how the regulation is going to cause them to take less risk, have more capital, right? To put up, if they're going to be on the hook, all these major money center banks, if there are more regionals that are going to have to tap these FDIC, like insurance funds, and they're going to have the major money center banks put up capital to pay for it, or as they had to do, put deposits in these regionals, that means that they're going to have less cash, right? And this is the whole earnings story to give back to shareholders. And the options market and the equity market is telling you that Bank America is likely to have to cut their dividend.
I don't know how to comment further. You just nailed it. And for some reason, people are separating the banks from the economy at this point, which is fine. Banks are not participating, as we mentioned at the top of the show, really in this rally. And I think it's kind of wait and see. There's no question there's going to be a ton of scrutiny on these banks going forward. And if you throw in what we believe, the three of us at least believe, is a slowing economy or potentially a recession, right? That's going to even feel worse, Dan, to that point. And so if they get restricted from buying back stock, again, part of the Schwab or paying out anything in the form of buying back stock or dividend, part of the reason for the Schwab downgrade was the analyst believes that they're not going to be able to do anything, to do either at some point. And so, yes, it matters. And it matters to earnings. The inability to buy back stock obviously hurts your share count. Obviously, you can't reduce it. Now, paying out dividend, you could argue if you keep it on the balance sheet, maybe you're not paying it out, it stays on the balance sheet. But I think what we're looking at here is a lower ROE profile in general for the banks going forward. And we're just now kind of adjusting to it. And no one can predict exactly, Dan, the mergers between all these smaller regionals and how this is going to play out. I think the problem here is this was the canary in the coal mine that Guy named the show kind of last week, a couple weeks ago. We're just kind of beginning. And again, people don't think that this, quote, crisis is over.